Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey.
Magnificent.
Hey. The last episode covered risk management. Forecasting is how you understand what that risk actually looks like. A forecast starts with data, then turns that data into a range of possible outcomes. It's all about taking the information that already exists, organizing it, and asking what outcomes are most probable before the company reports. Price moves when reality lands outside of expectations. If you want to see some good forecasting examples, Region Formal on Reddit and Bad Robot on X do a pretty good job for GME. And if you want to build a simple forecast like a pro, start with 4 buckets of data: company history, company guidance, peer and industry data, and current consensus expectations. You can pull company history from quarterly filings, earnings presentations, and transcripts. That's where you'll find revenue, margins, and earnings, and any other KPIs that drive the business. Guidance comes from management commentary. Peer data comes from similar companies reporting around the same time. Industry data is usually found through a quick search of the company's main driver, plus words like industry data, market trends, index, or report. Then consensus gives you the market's current baseline for revenue and EPS. That last piece is important because a forecast by itself doesn't tell you much. You're building a number to compare against what the market already believes. If consensus expects a company to earn $1 per share and your process gets you to about the same place, there might not be much surprise there. But if you land well above or below that, then you might have found a gap that could move the stock. After you gather data, choose the drivers that deserve your attention. This is where forecasting can get easier than you think. Most businesses can be simplified into a few key drivers. For revenue, it's what causes sales to happen. For a retailer, maybe it's store count and sales per store. For software, maybe it's customers and average revenue per customer. For a manufacturer, maybe it's units sold and average selling price. Revenue is usually some version of volume times value with industry-specific language. Then look at the history of those drivers, ideally the last couple of years by quarter. You want to see trends, seasonality, and volatility. Does revenue usually spike in holiday quarters? Do margins dip during product launches? Has pricing improved for 3 quarters in a row? History gives you a base rate, and base rates keep you from starting with pure opinion. After history, look at what changed this quarter. This is where guidance, peer results, and industry data come in. Maybe management guided cautiously. Maybe competitors just reported stronger demand. Maybe freight costs fell. Maybe pricing is improving across the industry. You're taking the historical base rate and adjusting it with current information. At this point, rather than making a claim on what you think revenue, margin, or EPS will be, the better approach would be to build scenarios. A downside case, a base case, and an upside case. Those cases should come from the data you just gathered. The range shouldn't be random and should reflect historical behavior plus what changed. Let's say you're forecasting a retailer. Over the last 8 quarters, same-store sales have ranged from flat to up 5%. That gives you your starting range. So instead of shifting the range itself, you stay inside it and position your scenarios within it. Downside case up 1%, base case up 3%, upside case up 5%. Then assign probabilities based on evidence quality and uncertainty. If history is stable, guidance is clear, and peer results line up, the base case can carry more weight. If the quarter has unusual uncertainty like tariffs, a product launch, or shifting demand, spread the probabilities out more. So maybe you weight the retailer scenario by assigning 25% probability of the downside case, 50% for the base case, and 25% for the upside case. If the evidence is messy and conflicting, maybe it's 30-40-30. Probabilities reflect how wide the range really is. And now you can calculate a probability-weighted expectation. If the 3 revenue outcomes are 1%, 3%, and 5%, and the weights are 25, 50, and 25, your weighted expectation is 3%. That's your working forecast for that driver. Then repeat the same exercise for other important drivers like gross margin or operating expenses. Usually 2 or 3 key drivers explain most of the quarter. Margins and cost behavior usually matter more than revenue because they determine what actually turns into profit. Some costs move with sales and some don't. That's operating leverage. A company can grow revenue and still disappoint if costs rise faster, and it can lose revenue but improve earnings if it becomes more efficient. That's why the bottom line can carry more weight than the top line. So when forecasting margins, use the same process. Look at the company's recent margin history, then ask what changed. Are input costs lower? Is the company discounting more? Are they selling a better mix of products? Build downside, base, and upside cases, assign probabilities, and calculate a weighted estimate. Forecasting EPS is pretty straightforward from here. Take revenue and apply your margin to get operating profit. Subtract interest, apply a rough tax rate to get net income, then divide by shares outstanding. You just forecasted EPS. Now compare your forecast to consensus. If your revenue revenue and EPS estimates are roughly in line with consensus, the market might have priced in that outcome. If your work suggests results could land meaningfully above or below consensus, then you might have identified a surprise. And now you can forecast. Start with data, find the drivers, anchor to history, adjust for what changed, build a range, assign probabilities, and carry it through to EPS. When you're forecasting, you're trying to find the gap before the market does. Like, subscribe, follow @TheMagnificent on Instagram and X, and let's keep the education going every Sunday at 11 a.m. Central.